Hi, I'm Shanne Sleder with Team Sleder. Although I've been helping homeowners over 62 with reverse mortgages for almost 2 decades, it's not lost on me how confusing all the information surrounding reverse mortgages can be, including all the myths that have circulated for years. If you have started to look into reverse mortgages and feel overwhelmed with some of the terms and processes, don't feel defeated yet. I'm making this video to answer our most frequently asked questions to provide you with some clarity on reverse mortgages and the process to obtain one, and to help make your experience as smooth and stress-free as possible. This video consists of 14 of the most frequently asked questions by our clients before and during the reverse mortgage process. So without further ado, here is number 1.
What is a reverse mortgage?
A reverse mortgage is a special loan program created specifically for senior homeowners that allows them to tap into a portion of their home equity, continue to reside in their home, and defer any payments on the loan balance until the home is eventually sold. There are several different types of reverse mortgages, but the most common one is the FHA-insured Home Equity Conversion Mortgage, or HECM for short. The best definition of a HECM is a federally insured loan product that allows homeowners aged 62 or older to access a portion of their home equity in cash, monthly payments, or a growing line of credit. With a HECM, the borrower retains ownership of the home, but must occupy it, maintain it, and pay all property charges.
How is the reverse mortgage loan amount determined?
There are 3 pieces of information that are needed to determine how much money is available through a reverse mortgage, or what is called the principal limit. The borrower's age, current interest rates, and the home value. Assuming the same data is used, principal limits should be consistent from lender to lender. The age of the youngest borrower, or eligible non-borrowing spouse, is used to calculate the principal limit. The older you are, the more you generally qualify for. The expected interest rate is also part of the calculation. The higher the rate, the less money will be initially available to you. The lesser of the home's value, or the HECM loan limit, is the third piece that goes into calculating the maximum loan amount.
What are some common misconceptions?
The most common misconception is still that the lender will own your home when you obtain a reverse mortgage, and that you will lose any equity you would have. This is not true. The reverse mortgage is just a lien on the property like any other mortgage. Homeowners retain title and ownership and can choose to sell their home at any time. And any equity that is in the home after paying off the loan balance still belongs to the homeowner or their heirs. The second most common misconception is that you have to have your home paid off to get a reverse mortgage. This is also not true. We help many senior homeowners use a reverse mortgage to get rid of their current mortgage and the payments associated with it. The third misconception is that reverse mortgages are a last resort option. Many believe that only the desperate get reverse mortgages. Actually, we are seeing more homeowners use reverse mortgages as a financial planning tool even when they have assets, and others who use it to improve the quality of their retirement.
I have heard reverse mortgages are non-recourse loans. What does that mean?
The non-recourse feature of reverse mortgage is one of its most powerful aspects. This feature states that the homeowner is not held responsible if the loan balance grows beyond the home's value. This can give the homeowner peace of mind that they will not be leaving their heirs with a large debt. The actual definition is, FHA guarantees that neither the borrower nor their heirs will owe more than the home is worth at the time it is sold. There is no recourse for any deficiency, and the heirs can sell or refinance the home if they wish. FHA assumes the risk of the loan balance exceeding the home's value. The home is what covers the debt, not the homeowner and not their heirs. This should be reassuring to every HECM borrower and their heirs. They can be assured that if a homeowner lives a very long time, or property values drop, or interest rates rise significantly, FHA will pay a claim so that nobody is harmed by the loan being upside down or underwater. In fact, upon the death of the last borrower, the heirs may qualify for a reduced payoff of 95% of the home's value for homes with no equity.
Does the required mortgage insurance benefit me?
With traditional mortgages, mortgage insurance exists to protect the lender in case of default. With reverse mortgages, there is a similar benefit to the lenders, but most homeowners and heirs are unaware that this insurance is also for their benefit. Here are a few of the benefits that the mortgage insurance provides. Number one, the mortgage insurance is what pays for the non-recourse feature, so you can never owe more than the home is worth. Number two, it is also what allows the homeowner to live in the home as long as they want, regardless of the loan balance, as long as they follow the terms of the loan. And number three, it is what guarantees the growth rate feature on the line of credit disbursement option, allowing borrowers to have more money to draw in the future. And number four, it also guarantees that the line of credit can never be frozen or have a balloon payment.
What are the eligibility requirements for a reverse mortgage?
While lender guidelines and product guidelines may vary, the four following requirements remain somewhat standard for reverse mortgages. Number one, age. With the HECM product, the youngest borrower must be at least 62 years old. However, non-borrowing spouses may be younger than the required age. On jumbo reverse mortgages, the youngest borrower can be 55 years old. Older borrowers generally qualify for more funds in both options. Number two, homeownership. To qualify for a reverse mortgage, you must not only be the homeowner, but also have significant home equity. When purchasing a home with a reverse mortgage, the borrower will become the homeowner on the new property and will need to occupy it within 60 days. Number three, residency. The home must be the homeowner's principal residence. This program is not available for second homes or investment properties. The lender will verify this during underwriting and will also require an annual occupancy certification confirming that the homeowner is still residing at the home. And number four, property type. The accepted list of eligible property types includes single-family residences, 2 to 4 unit properties when the borrower occupies 1 unit, townhomes, planned unit developments, modular homes, manufactured homes that meet FHA requirements, and condos.
What are my options for accessing the equity?
The fixed-rate HECM is a closed-end loan and only offers a one-time, single disbursement of all the funds available to you. But the adjustable rate HECM has various payout options that include the following. Number one, an initial draw. This is a lump sum of cash drawn at the time of closing. Number two, a line of credit. This is the most popular payout option. A line of credit allows a borrower to take what they need, when they need it, and only pay interest on the money they have borrowed. Number three, a 10-year payment. Tenure means permanent. With this option, the borrower's net principal limit is converted into regular monthly draws. These payments will continue as long as the borrower occupies the home and follows the program guidelines. Number four, term payment. If the calculated tenure is too small, the term payments may be higher. These are regular monthly draws for a specific period of time. This option works great if you only need monthly cash flow for a specific period of time. And lastly, you have either modified tenure or modified term. A modified payout is a combination of monthly payments and a line of credit. The primary advantage of a modified option is the ability to combine cash flow with an emergency fund.
What is the line of credit growth rate?
The line of credit option on a reverse mortgage is guaranteed to grow at the same rate as the interest rate and FHA mortgage insurance premium, which is charged on any outstanding loan balance. This is not a rate of return on your line of credit like an investment, but a growth in the amount of money you can borrow in the future against your home value. This is one of the greatest benefits of a reverse mortgage. In many cases, the amount available in a line of credit can double from the age of 62 to 82, allowing for more money to be available when you really need it. And the growth is independent of the home value. So even if home values stay flat or decline, your line of credit will be growing. In some cases, the money available to draw from a line of credit may be more than the actual equity in your home, making it a great hedge against home value depreciation.
Can I make a payment on my reverse mortgage, and what are the benefits?
Yes, you can make payments on your reverse mortgage if you choose, even though they are not required. You can pay partial interest, all the interest due, or some principal and interest every month. When you make these payments, you will keep the loan balance from growing as much as it normally would, so this will keep the overall interest accrual down as well as increasing the amount of equity you have in the property. If you established a line of credit on your reverse mortgage, any payments you make, even if they are just partial interest, will be added back to your line of credit so that you can borrow it in the future, and it will help your line of credit growth factor. This is the only mortgage product available that allows you to pay interest on the loan to keep the balance from growing, but then allows you to borrow that money back in the future when you need it. In addition, any interest paid may be tax deductible in that year.
What is the difference between a home equity line of credit, or HELOC, and a reverse mortgage line of credit?
A traditional home equity line of credit, or HELOC, allows the homeowner to access a set amount of equity from their home. HELOCs require the homeowner to make monthly payments based on the current rates and how much they draw out. Homeowners also have to be able to qualify for the monthly payment. The homeowner can usually make draws for up to 10 years, but then after that, they will no longer have access and they will have to start making principal and interest payments over a 15 to 20-year period, causing their payments to increase over that time. HELOCs can also be frozen in a down market where they will no longer have access to those funds. Reverse mortgage lines of credit require no monthly payments and are easier to qualify for those 62 and older. The draw period never ends and the line of credit can never be frozen. The homeowner can pay the line down and then use it again and again in the future, over and over. The line of credit available also grows over time, so more money can be drawn down the road.
How can a reverse mortgage help me get more money from Social Security?
Many times, seniors decide to take Social Security early so that they can start to receive the monthly income to help with monthly expenses in retirement. By taking it earlier, though, it reduces how much they will get per month for the rest of their life. Instead of taking your Social Security early, use a reverse mortgage to supplement your income and wait until age 70 to take Social Security. This will allow you to lock in the maximum amount of Social Security available to you.
How is the reverse mortgage paid back after the last borrower passes away?
There are 3 options available to the heirs. Number 1, repay the loan by refinance or some other means and keep the house. The heirs do not have to pay more than 95% of the appraised value of the property. Number 2, sell the property, repay the loan balance, and keep the remaining equity. Or number 3, deed the home over to the servicer and walk away if the loan value exceeds the home value. FHA insurance covers the lender against any losses.
When is a reverse mortgage not a good option?
Despite the many advantages of a reverse mortgage, it is important to recognize reasons not to obtain one. Here are a few reasons why a reverse mortgage may not be the best fit for you. Number 1, the home may not fit the homeowner's long-term needs. If the homeowner intends to sell the home soon, or if the home does not meet their long-term physical needs, a reverse mortgage may not be a good fit. The program was designed to meet the needs of older Americans who wish to age in place. Number 2, the reverse mortgage may not provide a tangible benefit. The reverse mortgage needs to provide a sustainable solution throughout retirement. If the reverse mortgage offers little current or future advantage, the homeowner should look for other options. And number 3, there is an adult child living with the senior homeowner that will need to continue to live in the home after they pass away and won't be able to afford to refinance out of the reverse mortgage.
What are the benefits of using a reverse mortgage to purchase a home?
Using a reverse mortgage to purchase a home allows those over 62 to right-size into the home they need for retirement, but be able to do that without putting all the proceeds from their previous sale into the new purchase. This can allow the home buyer to keep money liquid for home improvement, medical needs, or other retirement needs. And by using a reverse mortgage, they still accomplish their goal of having no monthly mortgage payment required. We understand that choosing to get a reverse mortgage and who to work with during the process is not a decision taken lightly. If you are still deciding, or if you have already decided to work with us, we want you to know that we are committed to providing you a 5-star client experience filled with advice and reverse mortgage strategies that are not always common in this industry. I really appreciate you taking the time to watch this video. It's our hope that by watching this, you will have more clarity around reverse mortgages and some of the benefits they provide. If you have any further questions in the future, please give Team Sleder a call. Thank you so much.